Yeah.
Could you go to the chart where you show the 5 quintiles beta?
Yeah.
The first and second quintile were very close. It also seemed like the second quintile was maybe better than the first quintile in some places.
Yep.
Do you have any views on why that would happen?
No, I think it's mostly that so a lot of this empirical analysis I'm showing you is very, very preliminary. We're doing a bunch of other stuff. So there's a lot of different ways you can calculate beta. Just calculating beta itself is a complicated process. I mean, I'm kind of making it sound extremely easy, but there's a lot of other things you have to do. My sense is that, there's a lot of noise associated with, these betas, and so that the extreme beta portfolios are probably more informative than if you're kind of comparing like the lowest quintile beta to the second quintile beta. Is my guess what's going on? That if we could kind of get a better and more accurate measure of beta, you would get a much more monotonic relationship. So I kind of attribute that to probably more sampling error issues. And our sample period is still not very high. It's still only about 30 years of data. Yeah.
Okay. My question is that can you predict when the disagreement is going to be high among analysts?
Yeah.
And the second question is that if you are taking actual traded stocks, how the use of derivatives blurs that distinction? Because nowadays derivative trading is taking place more and more instead of actual stocks.
Right.
And they change beta using derivatives and ETFs. So how is that going to modify your data and modify your conclusion?
Two very good questions. I don't have an answer to where one would forecast what's driving this disagreement. I don't know that it's so important. It depends on kind of what you're doing. So here, if you look at our data, the persistence, of these conditional periods is not like a daily thing. They last for a while, right? I mean, so if you look at our data, the persistence is something on the order of like 2 to 3 years. Yeah. So there's time basically for you to use existing signals. So like if you see that there's been a big spike up in analyst disagreement, it's gonna last for a while. And this is not a highly choppy process, right? Usually what's going on is that there's a shock that has created this disagreement, right? So some of it may be prices, some of it may be the state of the macroeconomy. So kind of the way I would use initially the information is simply, hey, you know what? Flag that there's a lot of disagreement going on. Observe that therefore here during this period, high beta stocks might be particularly speculative, and I might want to think about how to therefore manufacture or create my portfolio. So there's that. Can you do better? Sure. I think you could do a lot better. I mean, I don't know. I think we're just kind of beginning to scratch the surface in terms of here in this paper, just identifying what the problem is, right? There's a lot more you can probably do. We haven't kind of done that stuff. As far as the derivatives, there's kind of two views on that. If you think that a lot of the derivative trading represents basically shorting, then that would suggest that this is going to matter less and less in the future, right? Because if guys are really able to short and express their optimism, then this mechanism is probably going to be less powerful. But if you think that the derivatives is simply just another way to manufacture a long position, right? Because it's just more efficient to trade derivatives, which is what's happening a lot with bonds. So nobody trades the bond, they trade the credit swap. But it doesn't mean that they're shorting the bond. It's just another way to buy the bond, right? It's just cash. In that case, then the theory is fine, and you probably want to measure the beta in a slightly different way, right? Which is to go and kind of measure it in the derivative market, but you would still get the same conclusions. Okay, so the critical distinction is, are guys using derivatives to short, or are they doing it just to manufacture more efficiently a long position? As long as it's just to do that, then the theory is still fine, and you're still going to go with, you just would measure beta in a different way.
But will it not change your result? Means the beta might not have a kink. This security market line might not have it.
It will have a kink as long as the guys are not doing it to short. As long as the manufacturing of the derivatives is just to long the stock, right? In other words, instead of buying the stock, I buy the call plus some cash. That's fine. Now, if guys are actively going in and saying, well, I think that these stocks are overvalued, now let me short, okay, by buying a bunch of puts, that's the way that I'm shorting. But the thing is that that's not really happening, and you know why that's not happening. Because if that was happening, short interest in the stock would go way up, right? Because when guys are buying puts to actively short, the market makers then have to hedge to supply all the puts, right? And therefore, they're going to have to short on the stock. So one way or the other, you can look at shorting in the stock and see what's going on. So shorting, for instance, is still not that high. In fact, actually, shorting interest, if you look at stocks, have come way, way down recently for a lot of institutional reasons. Okay. So I think you can look at the short interest of the stock, see if there's a lot of shorting. The plots I showed you, there's a very small amount of shorting that's going on. Not that much, really.
Okay, on behalf of time, maybe we should ask.
Okay, some other questions? Yeah.
How about
Yeah.
the one, right?
Yeah.
Thanks for coming all the way out here.
Yeah.
Two questions. The first is your lambda concept.
Yeah.
How you derived that. I guess the question is, could you use volatilities around the asset prices, the stock prices in this case, or even extend that into the implied calls from the option market, given that they're pretty liquid? The second question is there a way, the relationships you've described are pretty clear and statistically significant, I assume I haven't seen the T's
Right.
Is there a way to prove causality in terms of what is actually causing the change, whether really, the right factors?
Yeah, two great questions too. On the volatility point, there may be, I think what you're suggesting is, are there kind of smarter ways to gauge whether the stock is speculative?
And also could show early warning signs.
Yes. So here, I think both volatility and volume would be very interesting measures, because unlike the disagreement measure, which I think is naturally more limited in terms of the data we have, we can go back into the 20s by using kind of the volume data. So I think that that's kind of to be done. So I think that the concept is clear. I think the implementation of the concept has a lot of different venues that one could try, and I don't have a really strong sense of which one is going to work out better. I actually think that the volume stuff could be pretty interesting, and I think the volatility stuff, by your kind of analysis, I haven't talked about, which is also true, stocks that are more highly traded in this model will also be more volatile. Yeah, so that's going to definitely be the symptom that's there. Okay, so I think that's certainly a plausible route. As far as the kind of doing the causality, we try to do a little bit of it by pointing to, look, high beta stocks in times of more uncertainty. In fact, yes, the analysts do disagree more about the cash flows of high beta stocks. That's a causal mechanism that we're attributing. Look, it also seems that some hedge funds are kind of trying to short this stuff on the side, thinking that therefore some of these high beta stocks might be kind of more overvalued. If you think of it again as shorting is representing that these are more kind of overvalued stuff. Is there a smarter way to do this? There's probably, yes. Okay, I don't think we've kind of nailed the last part on causality. What I would like to see is some of this stuff replicated internationally, into other contexts, to look at kind of like, also have other measures of disagreement beyond the analyst forecast, maybe look at some macro forecasters, look at some other stuff, seeing if this is basically also picking up what's going on as far as explaining this kink. I would say that the one part that I'm optimistic about our causality is that I do think the model generates a pretty unique prediction, which is this nonlinearity, right? Which is this kink. Yeah? And I think that the kink is unique. You could generate this kink in a couple of different other ways that I know of. But I don't know that that's any more better than kind of this particular mechanism. So for instance, one mechanism could just simply be that there's just a lot of indexing, okay? And guys want to efficiently index by buying a bunch of high beta stocks, right? So that again, I don't think of that as completely different from our story, I think our story is just basically going to nest this version of this, indexing, guys buying a bunch of high beta stocks is kind of pushing in the same direction of what we're saying. And you might think that, below a certain beta, they're not going to want to do much indexing using kind of the super low beta stocks. They're going to concentrate most of their attention on very high beta stocks because it's much more efficient for indexing. I think that's going on too. I think that has to be going on because indexing is such a massive effect in financial markets. So I think it's kind of the combination of these two things that are going on. Yeah?
I just want to know what else that we look at in terms of definition of macro-disagreement. Say, you're looking at the analyst estimate on the stock or S&P. If you look at other things like GDP, dispersion that.
Yep.
And we just take a step back.
Yep.
What other things have been tested in terms of identifying the key macro-disagreement?
Yeah.
Recession, growth, and also tightening, loosening, for example.
Yeah, so as I said, I think it's just sort of the work on this is beginning in the sense that the literature has not tried too many things. I think certainly one very big strand of work that's going to be coming is to begin to link up all of the different versions of disagreement that you mentioned, looking at standard deviation GDP forecasts or macro forecasters. There's lots of surveys, and to try to see if you can kind of come up with some principal component, some commonality that's driving all these different factors. So I think that's definitely kind of an interesting venue for thinking about the stuff. So we haven't tried all these things. You know, there's a lot of work to be done in trying to look at these other factors. And I think certainly globally would be, I think, kind of an important first step. Because one of the things that we observe about this low risk, high return puzzle is that it's global. It seems to be kind of in all markets.
Okay, do you have any more questions? Maybe especially from the East? You want to have different opinion about the talk, right? From both gentlemen and ladies. We do not have any more questions. And please join me to give a storm of applause to.
Thank you.